Hello everyone, welcome back to another video. If you're new to this channel, my name is Farhan and I help accounting students like you ace your exams. Today we have a practice question with 3 transactions and we will learn how to correctly debit and credit them and also understand the reasons behind the account being debited and the account being credited. So you can see the question on the left hand side of your screen, and on the right hand side we've got the workings which I'll go through and explain to you step by step. So let's begin. During the month of June 2022, JC's business has the following transactions. So we are given 3 transactions on June 5, June 10 and June 21, and the requirement is to prepare the journal entries to record these transactions in the books of JC's business, and narration is not required. So when we are asked to do journal entries, we mainly have to show which account is debited and which account is credited. So let's read the first transaction. On the 5th of June 2022, the business bought an office table which costed $950 on credit from Priya Trading. So when we buy an office equipment for the business, we are buying a non-current asset, and this non-current asset has economic benefits which the business could utilize and help the business add more value to its customers, which will therefore help the business ultimately generate more revenue, right? So when we buy non-current assets in our business, our assets as a whole increase. And when assets increase, we always debit them, okay? So because we're buying a new asset, we are debiting the asset account, specifically the account for office equipment, by $950. Now, office table is a furniture, so you could also debit the account for fixtures and fittings. You would still be correct. So there is no issue because office equipment and fixtures and fittings, they're just synonyms, all right, to each other. All right, so when we buy on credit from Priya, we have a liability that's happening, which means we have got a present obligation to pay off Priya Trading in the future. So when liabilities increase, we always credit them. And in this case, we'll credit the account for Priya Trading, and we would show it as other payables, not trade payables, because trade payables are those group of people who are the credit suppliers of the business. So the product that you buy on credit from your suppliers and then sell that same product at a markup to your customers, that is what you can call a trade payable. But in this case, we're buying a non-current asset on credit. So the correct terminology would be to write other payables, specifically the account for Priya Trading. A liability is taking place, all right? And the amount in this case is $950. Okay, so when assets increase, we debit them. When liabilities increase, we credit them. All right, so let's look into the next transaction on June 10. Rudy returned goods $100 to JC's business as they were faulty. So Rudy can only return goods to JC if Rudy had some previous arrangements with JC, right? So we understand based on this statement that Rudy is a customer of JC, and in the past, JC sold some goods to Rudy, and we are assuming this was done on credit, all right? So normally, when it comes to doing businesses, if you have been doing business with a customer for a long period, you develop this trust, and in most cases, you would want to enter into credit arrangements, all right? Now, in the past, when the sale would have been conducted by JC with Rudy, in the books of JC would first record a current asset, and because assets are increasing, JC would debit the account for Rudy, trade receivable Rudy, which refers to the fact that Rudy is a credit customer. And because assets are increasing, JC would debit it $100, all right? Another reason we're assuming this transaction to be on credit is because the question does not mention anything regarding cash on June 10, all right? So it's not specifically or explicitly mentioned, so we have to assume confidently that this is a credit sale. So when the sale has been done, we debit the account for Rudy, trade receivable Rudy by 100. And because it was a sale, every time the business makes a sale, we credit the account for sales revenue by 100. And by default, when revenues increase or sales increase, we credit them, okay? All right. So on the 10th of June 2022, when Rudy would have returned $100 worth of goods, Rudy would now owe less money to JC, right? Okay, so Rudy will now owe $100 less to JC. So in the books of JC, this needs to be reflected. So what JC will do is credit the account for Rudy by $100, which basically says that assets are decreasing by $100 due to the returns initiated by Rudy. All right, and simultaneously, we would create another account, which is the sales returns account. All right. So if sales revenue account by default is always credited, which means when it increases, we credit it. All right. What happens is that to reduce the sales, we create another account whenever there is any return, and that account is the sales returns account. All right. So sales returns account, when it increases, it's debited. So whenever there are any returns, we debit the sales returns account. And in this case, it is $100. All right. So you understand the different events that would take place on the day the sale was actually made and the day the returns would have actually been processed. So the way we enter the transactions in the books. All right. Okay. So let's now go to June 21, 2022. JC took $30 from office cash for her personal use. Because it is very clear that this money has been withdrawn for personal use, we can confidently debit the account for drawings, all right? So whenever there is any withdrawal, whether it is cash or goods from within the business for personal use, we debit the account for drawings, all right? And the reason we debit the account for drawings is that initially when JC would have invested money into the business, we would have called it capital. And by default, any investment into the business, any capital investment into the business would have been credited, right? So whenever there is any kind of drawings, it is basically a reduction in that capital that is invested into the business originally, right? So obviously that reduction will now be reflected in a separate account, which is what we call the drawings account, which is basically showing all the reduction in capital, all right? So debit drawings account by $30. And because it was cash that JC withdrew from the business, so we would credit the account for cash in hand by $30. Cash in hand, obviously, by default is an asset account, which means when it increases, we would debit it. But now that there has been some kind of withdrawal, it is reducing. So therefore, the asset has to go down and we would credit it. So we would credit the account cash in hand, $30. All right. Okay, so that's all for today's lesson. Thank you for watching, and check out the other videos and clear your confusion with any of the topics you have. With that being said, I'll see you in the next lesson.